Okay, everyone, we're going to go ahead and get started. We'll allow those that are running a little bit late to catch up with us and into tonight's content. So thanks again for joining us. This is our first workshop for 2023. Really excited to be able to bring this content to you. We get a chance to present home buyers workshops all across the country. In fact, this year we're teaching about a workshop per week. So if you enjoyed tonight's content, hopefully you'll share that with friends, family, maybe even some coworkers. We'll be broadcasting our next workshop, I believe, next week. So, the hope with this class is that this is going to guide you down the path towards home ownership. So you're going to learn a little bit about credit, loan programs, the process, really kind of all the ingredients that you'll need as a future first-time home buyer. We consider ourselves the leader in home buyer education, and we do that by really helping educate our clients and making sure they feel like they have all the tools and resources they need to be able to achieve that goal of home ownership. And so tonight's class is going to be, the goals and objectives for tonight's class will really be able to help get you on the path towards homeownership, whenever that is, whether that's a 2023 goal or maybe it's a 2 or 3 year goal out from here. Now, many of you that are joining tonight's class have heard about us and our services through our wonderful partnership with Sac State Alumni and Athletics. So, stingers up for those that are joining us tonight from our Sac State partnership, or maybe you just heard about us through our local community events that we have here in Sacramento. So just a little bit about me. Again, my name is Jason. I'll be the presenter for tonight. I'm also our branch manager for our office here in downtown Sacramento. From our office here, we not only service the Sacramento and greater Sacramento area, but we service all of California, including some other states that we support as well. We are a nationwide lending company specializing in mortgage products. So here's what you're going to learn a little bit about tonight. So in just a minute, I'm going to talk a little bit about the housing market. We're going to look at a budgeting exercise to look at what it could be of renting versus buying a house. We're going to share some tips around credit, what it looks like in terms of student loans and how that could potentially impact your qualifying. Talk about loan programs, documentation needed for the home buying process. We'll also spend some time looking at first-time home buyer programs. We specialize in first-time buyer programs. In fact, that's one of the things that we're known for in our communities that we serve. We partner with CalHFA, which is the California Housing Finance Agency, designed to help low to moderate income households achieve the dream of home ownership. So we're going to share with you some of the products that are available through CalHFA as well. And then I'll wrap up tonight's discussion looking at the process of buying a house. We call that the 6 steps of home buying. We'll talk a little bit about a consultation. And then, as I mentioned earlier, we'll wrap up with any kind of final questions that you have for tonight's discussion. Okay? All right, so let's go ahead and dive into kind of really looking at the whole notion around buying. Does it make sense? Purchasing a home is probably going to be one of the largest investments you make in your financial futures. So taking the time out to attend a class like this and do kind of all your homework to make sure you're in the best possible position is really a wise decision. When we think about buying a house, not only is it going to be one of the largest purchases we make in our financial futures, but we have the opportunity to create future wealth for ourselves. But not only that, we create stability in our housing budget. Do I have to worry about a landlord increasing the rent like many landlords are doing right now? No, because I'm going to be able to kind of control my budget based upon what I decide to purchase with my home. The value of the home hopefully will appreciate over time. The difference of what the home is worth versus what you owe on a house, that difference is called equity. Many, U.S. citizens are be able to accrue wealth just because of just the growth of the appreciation of homes. Just a few months, equity levels were at all-time highs. And, we've had so many success stories of first-time buyers that have purchased their first home and have been able to accrue equity and then be able to roll that equity into their next purchase of their home. And there still remains some fantastic benefits for tax savings when it comes to owning a home, the potential tax deductibility of interest. Now, where I like to always kind of start our workshops is around budgeting. So we can kind of take a look at an example of what would it look like if I continue to rent versus what would it be if I decided to purchase a home. So I'm going to walk you through just a little exercise we do through the Freddie Mac calculator that allows you to just be able to kind of see what a side-by-side comparison could be of renting versus buying. So let me go ahead and screen share this calculator with you. Now, I want to let you know all the content or all the slides that I present to you this evening, we're going to go ahead and share them with you via email tomorrow morning. So if, I really encourage you to take great notes, because that'll help you kind of retain some of the stuff and probably bring up some great questions for a later date. But you will get all the presentation material from us tomorrow morning. Okay, so let's dive in and look at just an example of renting versus buying through this calculator. So this calculator, which is found on the Freddie Mac website, you can input whatever numbers are applicable to your financial situation. I'm going to go ahead and plug in some myself, and just based upon some conversations with clients and kind of what we see typically with first-time home buyer situations. So I want to plug in a rent of $1,800 a month. Now I'm also going to factor in renter's insurance, which in this example, we're going to put $15 a month in renter's insurance. We're going to assume our rent goes up on average like 3% every year. So when I renew my lease, that potential rent is going to go up. Now, I'm also going to input my home purchase. And, this is going to vary for our clients based upon what their budget looks like. In this example, I'm going to put $350,000 just to get a kind of a little bit of a baseline for us with what it could look like from a budgeting perspective. Okay, so we're going to plug in $350,000. Now we have our down payment of 3%. Now we're going to learn a little bit more about programs in just a minute. The minimum down payment on a conventional loan is 3%. The minimum down payment on an FHA loan is 3.5%. So many of us think that FHA is the only option as a first-time buyer, which is not the case. In fact, I was just having that conversation with one of our clients this evening to go through those options. We're going to talk about programs in just a second. Okay. I just had a question that came in about the calculator. Yes, we're going to definitely share with you the link for this calculator. So it's already embedded into the slideshow. So we'll definitely get that along to you. All right, so we have our down payment of 3%. The property taxes on average, if you're going to look to buy in the Sacramento area, taxes on traditional resale homes are going to be anywhere between 1.1 to 1.25% of the price that we pay on a house. We're going to have our homeowner's insurance that we're going to add in here. We're going to factor in maintenance of our home. So we want to kind of put that into our budget. And then we look around loan information. Generally, we're going to have a 30-year fixed mortgage as a first-time buyer. And then let's plug in interest rates. Now, one of our topics tonight is going to be interest rates. We're going to talk about that. Had some interesting news that came out today with the Federal Reserve announcement on monetary policy. So we're going to spend some time looking at that in just a bit. The next section is going to be origination charges. That's what you're going to be paying for the cost of your financing. Now, for those of you that are joining us through one of our partnerships, we have a $750 discount when it comes to our closing cost services. So if you're joining us from Sac State, or maybe you're one of a state employee, we have a fantastic $750 reduction in costs. The next section is discount points. Now, you have the option when you get your financing set up to be able to reduce the cost of your interest rate. And that's through what we call discount points, where you're paying additional costs to bring down your interest rate. Generally, 1% of your loan amount equals 1 discount point, which can equate to anywhere between 0.25% to a 0.375% reduction in interest rate. When you purchase a home, you're going to have to save up money, not just for your down payment, but also for closing costs. So later on tonight, we're going to talk a little bit more about that. Closing costs when you purchase a home, I estimate usually around 2 to 3% of your sales price. Okay, so that's just something we want to kind of think about, because we're going to kind of look at options to solve for that equation around closing costs here a little bit later. Next section is going to be appreciation rate. So as I mentioned earlier, when you buy a house, the opportunity to increase the value of your home through the increase in home prices, that appreciation is something that hopefully we're going to see over time. Now, especially as first-time home buyers, we don't want to necessarily purchase to expect that we're going to have this massive appreciation rate in 1 or 2 years. It may take several years to reach those appreciation levels. I'm going to go ahead and plug in 7 years as our expectancy in the home. Okay. And then for when we eventually sell the home, let's say 7 years from now, we're going to have costs for selling the home. Those are going to be realtor expenses. There's going to be closing costs. Now, what's really cool about being a first-time buyer or a buyer in general in California, when you have a realtor that represents you, their commissions or their fees that they earn for selling a home are not paid for by you. They're paid for by the seller. So when we think about expenses that we have out of our pocket, that wouldn't be one of them that we would have to consider. We're also going to factor in state and federal tax rates. We put 33.8. Obviously, that varies by each client, and then a savings rate of 1%. So what this calculation comes back to us, it says, okay, now we're going to look at our payments. We do know that we're paying in rent about $1,800 a month. It's going to go up 3% annually. Now we compare that with a mortgage payment, which is $900 more a month. However, our opportunity of over 7 years when we do a total cost analysis is about a $42,000 opportunity of buying versus renting over that same 7 years. Because when I factor in the appreciation rate of my home, when I factor in tax savings, that creates that $42,000 opportunity. So when we think about owning a home, and I have several conversations with clients throughout the day, you know, when we think about $1,800 a month versus rent and try to equate that to $1,800 in mortgage, it just doesn't necessarily add up. It's not what we call an apples to apples comparison, because there's so many other benefits that come along with owning a home. Now, at the end of the day, we want to make sure we have a sound budget that's going to be a sustainable and affordable home buying plan. But you know, we want to ensure that, you know, we're factoring all the great value adds that come with owning a home. Okay. Okay, so let me answer a few questions, then I'm going to move on to our next topic. So let me just kind of read this question out loud, and I'll answer it on air, which is, what does it mean in the savings comparing just expenses of renting versus rent in 100% expense? So I think I just kind of not detailed that out, but kind of described what that means. So the savings means when I look at my rent situation, if I continue to pay $1,800 a month in rent versus my $2,900 in mortgage payment over 7 years, when I add back in appreciation of my home, hopefully appreciating at 3% versus my rent going up, and then the tax savings, that's where I get that $42,000 in savings. Okay. All right. Good questions there. And we're going to answer some of the other questions on air as we kind of get a chance to roll through tonight's content. And then some of you that have posted some questions in the Q&A, Ken's helping answer those for you on a one-on-one basis too. Just so you know, we did put the calculator in the chat too. So if you want to take a look at that, feel free to go ahead and do your own calculations there. And it'll also be in the presentation material that I send over to you tomorrow morning. Okay. All right, let's go ahead and jump back into our slideshow. And again, that was the rent versus buying calculator. So when we're thinking about budgeting, that's an awesome place to start. Now, let's talk about home prices. So, you know, there's probably a lot of questions that come out around what's going on with the market, what's going on with interest rates. Well, let's take a look at what's going on with the market and what we're seeing. And as we kind of look at this graph here, we can see home prices, you know, surge as we go through the pandemic. Interest rates led to prices just rapidly increasing, lack of inventory, high buyer demand. That all was a part of this massive increase we see where you know, home prices really kind of peaked out last year. Now we're seeing home prices starting to come down. What's leading that today? Well, what we're seeing right now is, well, interest rates peaked out last year. We saw interest rates hit as high as 7.5%. Interest rates have now come down to an average of 6%. They hopefully will start to come down even further. Lack of inventory is leading to what we're seeing, and not as much buyer demand as there was in the summer months where rates were reasonable. Now we're starting to see that demand start to come back. In fact, you know, we look at some of the activity we see in the market right now, a lot more buyers going into the market. Interest rates have cooled a bit, so that's helping fuel the market. And I think right now, as we kind of look ahead at the traditional spring and summer buying months where it's kind of most busy, we're seeing a lot of buyers getting ready to purchase. So I think there's a big interest out there. I think sales prices have become a much more manageable. When I reflect back on what we saw 7 or 8 months ago, we saw buyers, especially first-time home buyers, that were trying to compete with 20 and 30 offers on one home. Now we see maybe 2 or 3 offers on a house, and it really has become a buyer's market where first-time buyers especially have room to negotiate contracts. Now, we're not asking for the price of a home, that the list price of a home that maybe is at $450,000. Maybe I'm able to negotiate it for $430,000. So a little bit more flexibility in negotiations. The other thing we're seeing is sellers that are willing to help with what we call closing costs. You heard me mention that just a little bit earlier. So sellers willing to chip in a little bit. So I think that just lends to a much more favorable buyer's market in essence. So gives us a lot more flexibility as first-time home buyers entering the market, because for all of us that are doing this for the first time, it's something where we're kind of nervous, a little anxious, just don't know what it looks like, and maybe afraid to take that plunge in the market. And I think with a lesser competitive market, it makes it a lot more attractive for first-time buyers. Now, the other thing that's kind of driving buyer behaviors is interest rates. And as we look back at interest rates in the last 5 years, and I'm going to kind of just even go back just 30, well, let's say about 60 days, interest rates peaked out around 7.25% to 7.5%. That really pushed a lot of buyers to the sidelines. And at the end of the day, it just wasn't affordable to purchase a home. We were still recovering from peaked purchase prices, and interest rates had inched up, and it just really made it an unaffordable market for a lot of buyers, especially in some of our high cost of living markets like the Bay Area, or maybe even in the Southern California market. So that changed things quite a bit. Now what we're seeing is home prices starting to soften quite a bit. We're seeing interest rates starting to come down, and we love to see this trend of where interest rates are going right now. So as I mentioned earlier, interest rates are sitting around an average of about 6%. Today, the Federal Reserve, Chairman Powell talked a little bit more about monetary policy. They're really monitoring what's going on with inflation. In the last 2 CPI reports, so the Consumer Price Index, we've seen slower inflation. And so today, the Federal Reserve announced a 0.25% increase in the federal funds rate, which was expected. So the real question is, what do the Federal Reserve rate hikes look like going forward? And I think, as inflation will hopefully continue to tame, we should see interest rates be more favorable for consumers. I think tomorrow's interest rates will probably open into the 5s, so we'll probably see the high 5s tomorrow, given what we've seen with market activity after Chairman Powell's remarks were made earlier today. So I think those are all good signs for our future buyers that are looking to purchase in the next, spring, summer buying months, or even like right now. It all looks a lot more favorable. So hopefully we can maintain rates in the 5% level. It's not likely that we'll see rates move into the 4s, and certainly I would love to see us in the 2.5% range that we were a year or so ago, but probably not going to happen. I think the realistic number is for us to be in that 5% range. Okay, but this gives you a good sense of what things look like over the last 5 years. Now, one of the questions I get before we move off of interest rates is looking at adjustable rates versus fixed rates. And especially as us being first-time buyers, 30-year fixed mortgage is the direction we want to go, because we want to have more of a predictable, sustainable payment structure. When you have an adjustable rate, you have fluctuations after the end of the adjustable rate period. What's interesting about today's market is we have this, what we call an inverted yield curve occurring, which basically means, and you can see it really displayed here on this chart, where short-term and long-term rates really don't have much of a difference right now. So the risk reward that you get with an adjustable rate versus fixed, it just doesn't make a lot of sense for a consumer, especially as a first-time buyer. Now, when we think about interest rates, there's a few ingredients that go into interest rates. So it's not just a one-size-fits-all with interest rates. So, credit scores make up what's in an interest rate, the type of product we're going to elect, the amount we financed, our down payment. If I put 3% down or if I put 20% down, that could change what my interest rate looks like. You heard me mention it earlier, discount points are the ability to be able to bring down that interest rate with additional costs. And then depending on the term of the loan, that can also influence our interest rate. So if I have a 30-year fixed mortgage versus a 15-year fix, that could change my interest rate offering. The lower my term usually will produce a lower interest rate. So question just to follow up, somebody had asked a question, and I made the comment of not seeing rates at 2% again. Is that just a 2023 prediction? When I say not seeing rates going back to the 2.5% level, the reason why we saw 2.5% rates was just unprecedented times. We went through a pandemic, and all the fallout from that is really what led to the 2.5% rate. So it's not likely that we'll return that. Hopefully we don't, just from our, just what we experience globally in our communities. So I think that's why, we won't go back to that 2.5% level. Another question came in. If you were a co-signer on a home purchase previously, will you still be considered a first-time buyer? We're going to talk more about this later on, but a first-time buyer is someone who hasn't lived in a primary residence as an owner for the last 3 years. So depending on your situation, if that co-signed home you lived in that is your primary or not. Okay. All right. Great questions. I'll try to get to as many questions as I roll through tonight's content. Some of those we might have to table till we get to the sections because we have a really large group for tonight's presentation. So I just want to be able to respect everyone's time that you've allocated for this evening. Okay. All right. Let's talk a little bit about credit. So another big component of home buying. When I think about home buying and the hundreds of clients that we work with throughout the year, there's usually two kind of really important ingredients to a successful home buying plan. I think credit and be able to have you in the best possible position for credit. And I think the other thing is just down payment and seeing what resources we have available to be able to design our home financing. Every loan product has a minimum credit score. Okay. And so when we think about kind of the 4 core products, FHA, conventional, VA, USDA loans, they each have a minimum credit score, as you can see here on the screen. So it's our goal when we design appropriate financing options for you. We want to make sure that we have something that's going to fit our budget needs, but also make sure that you can achieve the qualifying as a buyer. Now, when we look at FICO score, and I think this is pretty important, when you look at the weighting of FICO score, here's what this looks like. So when you look at this chart here, 15% of what's made up in my credit is how long I've had credit. So the more mature my credit file is, the longer I've had credit, the higher my credit score could potentially be. 20% is going to be how much new credit I've tried to obtain, maybe new accounts that I've opened. More so, it's going to be around inquiries. Now, there's a difference between hard inquiries and soft inquiries. When you start our process through the pre-approval process, we always start with a soft inquiry, which does not impact your credit score. Most lenders will start with a hard inquiry, and you want to be careful that you don't have too many hard inquiries because that can deteriorate your credit score. There is a rule in mortgage and also in auto finance, and it's a 30-day window rule, which allows you as a consumer to shop around with different lenders for your financing. As long as it's within the 30-day period of time from inquiry number 1, it's the equivalent of 1 credit inquiry hit to your score when someone else pulls your credit. So if I shop around with 3 or 4 lenders and that's all within that 30-day window of time, that's the equivalent of 1 credit inquiry hit to my score. Again, as our process goes, we're going to start with a soft inquiry so it doesn't impact you in that regards. 30% is going to be how much I owe in credit card or revolving debt. That's also known as credit utilization. So when I compare my credit balances versus my credit limits, that's called credit utilization. So if I have $5,000 in credit balances and my credit limit is, let's say, $10,000, right now I'm at 50% utilization. If you're trying to optimize your credit score, you really want to try to get that credit utilization below 10%. If you maybe have charged up a few credit cards because you had a bunch of holiday expenses and now you're at 80 or 90% utilization, we really want to work towards getting below 50% utilization. That would be the goal. When you look at your credit cards, there's a due date for your credit card bill, and there's also a billing cycle date. If we can manage our credit cards to the billing cycle date, that's going to help you optimize your credit score. So here's what I mean by that. So your billing cycle, let's say it ends on the 20th, but your credit card due date is on the 4th. Now, if you're in the habit of paying off or making a large payment on your credit card on the 4th of the month, that's fantastic. However, the balance that shows on the 20th on your billing cycle date, that's the balance that gets reported out to the credit bureaus. So I would encourage you, as you're managing those bills, if you can try to pay down or pay off that balance before the 20th, that billing cycle date, then you're going to have a much lower balance reflected on your credit bureaus and hopefully have a much improved credit score. Okay, so that's what I would kind of look at when you're trying to improve or maximize your credit score. The last component is going to be payment history. And obviously, as we know, that's probably going to have the most weighting, which is 35%. When I have late payments that I've had on a credit report, they're going to be rated in 30-day lates, 60-day lates, and 90-day lates. So it's or 90+ delinquencies. my lates that have occurred in the last 12 to 24 months are going to be the most impactful to my credit score. So when I look at my credit score, and if let's say I had a late of 30 days, 6 months ago on a student loan, because it's inside that 12 to 24 month range, it's probably going to hit my credit score more than if it was like a late back in 7 years ago. Okay. So that's kind of what the FICO weighting looks like. Now, when we look at past challenges, like maybe a bankruptcy, a past foreclosure, those late payments or hard inquiries, we're going to show you a little bit of a matrix on how long those things will appear on your credit score. When we evaluate financing options, we're always looking at the middle score for our borrowers. So as you probably know, there's 3 major credit agencies: Experian, TransUnion, and then Equifax. So if I have a 740 score, 720 and 700, I'm going to be evaluated off the 720 score, which is also known as my middle score. When I apply with a co-borrower, we look at the lowest middle score between both borrowers. So as we know, my score is at 720, but if my partner's score is at 700, 680, and 660, then we're going to use the 680 credit score to evaluate options, because that's the lowest middle score that my partner has. Okay. The last thing I just want to touch on before we leave the screen is just account closure. And what that means as it relates to revolving accounts is that you want to be careful closing out revolving accounts, especially the ones that have the most maturity on your credit file, because when you do that closure, it actually can negatively impact your score, especially if you don't have a lot of open accounts right now. Because if I've had an account for 10 years and then I decide to close it because I want to move and transfer to another card that has a little more perks or benefits, I'm going to lose all that 10 years of great history, which could do a couple things. It could impact my length of credit on my credit file, and it also could potentially limit my utilization if I don't have as much available credit. This is that matrix I was mentioned to you that kind of shows you how long negative items will remain on your credit. So those hard inquiries are 2 years or less, late payments, they'll stay on your credit report. The impact to the score could be in the first 12 to 24 months, but they'll actually stay with you for 7 years or less. So this kind of gives you some framework for how long those late payments will stay with you. Okay. I know we had a chat question that came in, which we're going to touch on now, which is around student loans and how they can impact your qualifying. I know many of you are waiting for some of the elimination of some of the student loan debt, and we're waiting for some of those bills to pass. At the same time, when it comes to qualifying for a mortgage, we do still have to include student loan debt, whatever the existing balances are, into the qualifying. So the federal student debt as part of the CARES Act is on pause right now, or in forbearance. However, because the debt is still owing, we still do have to count a minimum payment for you in your qualifying. So what I'll generally do is ask clients, what was your payment prior to the pandemic? And whatever that amount was, it's $150 or $300, that's what we have to factor into the qualifying. Hopefully you're on an income-based repayment amount, because that generally produces the lowest amount of payment needed for your student loan balances. In terms of loan programs and connecting that to the qualifying for student loans, there's 2 different kind of formulas we use. If you're utilizing FHA financing, which we're going to talk about in just a minute, we're going to automatically count 5% of the outstanding balances as the monthly payment. Or if you're on an income-based repayment amount, we'll count that. So if it's, $250 per month, that's what we use for an FHA loan. For a conventional loan, the default is 1% of the balance. Or if you're on an income-based repayment amount, that's what we use there. For some of our clients that have a zero payment because they're on a zero income-based repayment amount, that's what we can use for qualifying on a conventional loan. FHA loans will require at least a $1 figure for the monthly payment. Now, if you're back in school and now your loans are on pause because you are back in school, we still have to count that minimum payment amount for you on the qualifying for the mortgage. So forbearances, deferments, all that, we still have to count that minimum payment for the qualifying. So the question was, so as it is it best to have no student loan debt when it comes to applying for a home loan? And absolutely not. I mean, I'd say probably 70% of our clients have student loan debt in some way, shape, or form. Of course, it's better if we have less student loan debt, because that'll create more buying power for you, because at the end of the day, we have to count that monthly payment. But everybody's situation is a little bit different. So we encourage you to kind of map out that home buying plan with us. And if it does include student loan debt, maybe we need to have a strategy around maybe making sure that student loan debt or maybe other debts are paid down before we take that next step in home ownership. But that's part of what we do in kind of building that home buying plan for you. Okay. The question that just came in, I'm going to go ahead and just table that for a little bit later in our qualifying section. I'll have Ken kind of bring that up for us, and then because that's kind of a little bit more of a longer discussion. I do want to talk about loan programs, and what we've kind of set up here is our kind of 5 core products that most clients are going to utilize in financing, of which the conventional loan and the FHA loan is the most popular. Okay. So what we're going to do is we're going to dive into each one of the characteristics of these products and see how they could benefit you on your home buying journey. So let's talk first about conventional loans. And by the way, just as a side note, every year the loan amounts are updated for both FHA loans and Fannie Mae, Freddie Mac loans, which are conventional loans. So generally, January 1st of every year, those update based upon cost of living adjustments. As you can imagine, cost of living has gone up in California. So in the Sacramento area, we've seen larger loan amounts. So with a conventional loan, we can finance up to $763,600. Now, there's different loan levels, and not to complicate things more, but there's a conforming limit, which is right around 740 that we'll share with you in the actual loan amount in the chat, which goes up to a down payment of 3%. Once we get beyond that 740, it turns into what we call as a high balance loan. And then that minimum down payment jumps to 5%. Most of our first-time buyers are going to be in that 3% down level on a conventional loan. As you saw in the credit slide, the minimum credit score for a conventional loan is 620. Okay. Now, for an FHA loan, the minimum score is 580, but the minimum down payment is 3.5%, all the way up to that loan amount of $763,600. Now, we're going to talk about the features and benefits, or the comparisons, if you will, between conventional and FHA in just a minute, because I want to kind of talk to you a little bit more about mortgage insurance and how that relates to those two products. The next product is a VA loan for our veterans that have served. It's a 0% down payment option. Usually it's a minimum credit score of 620. That loan can go even beyond $1 million with 0% down. And that's a fantastic product. There's also assistance programs that can help support our veterans with the closing costs needed to purchase a home. USDA loans are going to be for our rural areas. So USDA, as you guessed it, stands for United States Department of Agriculture. So that product arm allows clients to purchase in rural areas. Like, let's say you want to purchase out in some of the North County areas beyond Sacramento, maybe the Williams area. USDA would service those lesser populated areas. There is some income restrictions and, as I mentioned, geography restrictions, but that can be a great tool for you as a first-time buyer. And then jumbo loans, which isn't typical for our first-time buyers. And the reason why is because it has a higher down payment minimum, usually requires 10 to 15% down for down payment. And those are for loans that go beyond $763,600. Now, what happens with jumbo loans is not only do we have to save up our down payment as well as our closing costs, but we also need what we call as reserves. And those are additional assets that are needed beyond the down payment and closing costs. And there's no assistance programs, unfortunately, that will be compatible with jumbo loans. The reserve requirement means that I need to have additional funds available that equate to a certain number of months of my monthly payment. So, for example, if my payment is $6,000 a month on a jumbo loan and there's a 12-month reserve requirement, that means I need another $72,000 in assets available. Okay, so not always super achievable for some of our first-time home buyers, but certainly if it's something that you're looking at the higher price homes as your first purchase, we certainly have product offerings for that too. Okay, so I want to talk now more about conventional and FHA loans, and we have a slide that we're going to dive into for what we call PMI, or private mortgage insurance. On conventional loans, when you put less than 20% down, you're going to have what we call PMI, or private mortgage insurance. And when we look at the comparison between conventional loans and FHA loans, it really centers around mortgage insurance, as well as some underwriting guidelines, which I'll talk about in just a second. But PMI is going to be based upon how much I put down, how much I finance, and then what my credit score is. Those factors will lead to that cost of premium. Now, there's different ways that you can pay PMI on a conventional loan. There's monthly options. There's what we call as a split option, where you can take part of it monthly, you can pay part of it up front. You can pay it all up front, which is called single premium, or you can increase your interest rate. So if my interest rate's 5.875 and I want to elevate it to 6.5 and buy out my mortgage insurance, I could do that as well. That doesn't happen a lot because we're really, we want to try to get the lowest available interest rate. So that scenario doesn't always play out to be favorable for the buyer. When we look at mortgage insurance on a conventional loan, and I have a little example here at the bottom of the screen. Let's say I was financing $450,000 and I have a down payment of 3%, and I assume my credit score is 740. The PMI amount's about $183.75. Now, for those of you that are doing your home searches on Zillow, Redfin, and you're running their calculators, that kind of gets you a little bit of a baseline for payment. But what I've found is those sites have astronomically high PMI that's not it's not set up or calibrated to all those factors that make up an actual PMI premium. Again, credit score, down payment, and amount finance. So just something to keep in mind as you're kind of doing your calculators. Our APM mobile app, which you're going to see the link on later on, has it all calibrated correctly so you can get more truer payments. An important feature with conventional mortgage insurance is it does have a cancellation option. So generally, when you have 2 years in that original loan and 20 to 22% equity, you can apply to have your mortgage insurance canceled. So that's a big deal to help create better future affordability for yourself. Now, there's always refinance options, which we can talk a little bit about later, but to be able to, hopefully achieve a lower interest rate, but also eliminate mortgage insurance. FHA loans, when it comes to mortgage insurance, is a little bit different. There's a standard 0.85% MI factor for FHA loans. So we take the loan amount times 0.85%, divide that by 12. That's how we come up with your monthly premium. But it also adds on upfront mortgage insurance. Okay. And so that is equated to 1.75%. The only way on an FHA loan you can cancel mortgage insurance is through refinancing. And that's where that can be a little bit challenging. And when we look at the FHA PMI example here, now we take that same $450,000 loan amount. The monthly PMI is about $324 a month, plus we have to add upfront PMI on top of that loan amount. So you may step back for a second and say, wow, why would I ever consider FHA? Because that payment is just going to be so much higher. Well, the way we want to look at this is when we design home buying plans, not all of our clients will qualify for conventional loans. FHA tends to be a little bit more lenient from an underwriting guidelines perspective. So we have lower credit score requirements, past challenges like late payments, maybe over limits on credit cards. Those aren't going to be as big of a deal for FHA, whereas conventional loans, it might be a little bit more of a challenge. So when we design a home buying plan for our clients, we want to kind of take all those kind of factors into consideration with your financial profile, seeing what makes the most sense for you to be able to help you achieve home ownership. The question I think came in the chat was, how long do we have to keep mortgage insurance? So just to kind of recap, so conventional PMI, minimum 2 years, and you have to achieve 22% equity to be able to cancel the PMI. FHA loans, it's going to be for the full 30 years. So I'm going to go ahead and somebody had a question. They were a little confused by the monthly PMI and upfront PMI. So there is 2 components to MI when it comes to FHA loans. So when you look at your payment breakdown, it's going to include principal and interest, homeowners insurance, property taxes, and then you have the line item for monthly mortgage insurance. So that's just on a monthly basis. But at the origination of your loan, so when your home loan closes, the amount financed, this $78.75 gets added into this loan amount. So not only am I just financing $450,000, now my amount financed just jumped to $457,875 versus a conventional loan, I'm financing just $450. So there's kind of 2 components when it comes to the mortgage insurance. So hopefully that answers your question a little bit better. Okay. Let's talk a little bit about documentation. One other question I'm going to answer on PMI really quick. So if you don't put at least 20% down on a conventional, just to answer this person's question, then yes, you do have PMI. Okay. All right, let's talk a little bit about documentation, really as it relates to income. And I want to kind of answer or kind of maybe dispel some myths around being eligible to purchase a home, because a lot of people think that I have to have 2 years on my job and be well into my careers to be able to purchase, which is just not necessarily the case. Let's first, though, talk about documentation. So as a W-2 wage earner, we're generally going to need the last couple of years of W-2. So many of you just got your W-2 because it had to be in your mailbox by January 31st. Last 30 days of pay stubs, and then we're going to verify your employment through the loan process. Okay, so that's going to happen. Now, if you're a self-employed individual, it's a little bit kind of more document intense, where we're going to need the last 2 years of your tax returns. We usually need a profit and loss statement. We'll verify the business through online sources, maybe a CPA letter. All those things we'll use to verify the business. Now, let's talk a little bit about some of the misconceptions and really kind of how financing, we kind of qualify income. So the rule is you do need to have 2 years employment and or education. So how that looks is that, let's say I just graduated from Sac State in the fall with an accounting degree, just started my new job, but I have 4 years of undergrad at Sac State, and now I just got hired on at Deloitte. And I can now use, because I just graduated from Sac State and I'm working in my field of study, that 4 years of undergrad counts towards the 2-year rule. Okay, so for some of our new grads, you can still use your income that you just obtained in your new employment. That can be used towards your qualifying. Another thing that comes up is if I'm in a job transition, so I'm working here for one employer, but I'm going to go to my next employer, do I have to be there for a certain amount of time? That's not the case. We can actually even accept an offer letter that dictates what you're going to be making in that new position. And then we can use that right away. Now, if you're going into maybe a commission-driven or incentive-driven role, we will need to see 2 years on that job in order to count the variable income. That's where that 2-year requirement is kind of a hard policy. Whereas if I'm expected a bonus or make commissions, I need to see that commission and bonus income for 2 years. Now, if you have a base salary plus commissions and bonuses and you don't have 2 years on the job, then we would just use the salary income for your qualifying. Another question that comes up is that when someone has dual employment, we see this a lot in the healthcare industry. So if I'm working at multiple healthcare facilities and I'm working 30 hours here, 20 hours here, can I use both sources of income? The answer is yes, if I've been on both jobs simultaneously for 2 years, or I can show that I've been in the healthcare industry and I've historically always worked 2 jobs in that field. Okay. Trying to think of another question that comes up quite a bit. If I'm coming back from leave or anything like that, and is there a certain amount of time that I need to be back on my job in order to count those earnings? There is no set time. When it comes to using offer letters for new jobs that you're expecting to get, we can actually even pre-approve you using offer letters. The way the rule works is that if I'm looking at homes this spring, for example, maybe I'm going to buy a house in March, and I have an offer of an acceptance today in February, and I go find a house in the next couple of weeks, as long as I get my first paycheck before my first mortgage payment is due, the underwriting team can utilize that expected income on your offer letter to qualify you for your mortgage. Okay, so those are kind of important things to think about when it comes to your income and how that relates to the qualifying. Okay, so we're going to stay with income, and I want to just quickly go over what we call debt to income ratio. So that looks at your monthly income versus your monthly expenses. It's a pretty simple calculation. For W-2 wage earners, we're going to use the gross monthly income, so your pre-tax income versus your monthly expenses. Generally, as a lender, we don't want your expenses to be more than 43 to 45% of your gross monthly income. In some cases, we can go up to as high as 49% of that gross monthly income, but our goal is to keep that 43 to 45%. Now, what's entailed into a debt to income ratio? Well, we look at a few things. We look at the principal and interest of your mortgage. We look at the property taxes. We look at the homeowner's insurance. We also add in PMI, like we just talked about just a bit ago. If that is something that's included into your financing, let's say I'm buying a condo, maybe a townhouse, those will generally have HOA fees or homeowners association dues. So in the example I have on the screen, if that sum of that monthly mortgage and payment with my HOA is $2,500 a month, and then when I add my student loan payment plus maybe a car loan, it's $500 a month. that means I have $3,000 in outgoing monthly obligations versus my pre-tax income of $8,500 a month. That means my debt to income ratio is at 35.29%. Now, the guidelines for most lenders will allow you to go up to 43 to 45%. Some cases you can go up as high as 49%. I think that's where we're going to have to really have that conversation with our clients to make sure that that payment's going to be affordable when we start pushing up to that high. What I found in working with so many first-time buyers that I have in my past is that most first-time buyers feel pretty comfortable around 33 to 36% debt to income ratio. One of the things we're going to do during your consultation, though, is design financing options. They're going to suit your objectives around payment. Because when I do that payment comparison of renting versus buying, we want to make sure that that's going to be a sustainable and affordable opportunity here for you. Okay, the last component to designing our home buying plan is our savings or down payment for our home purchase. As you heard earlier, the minimum down payment is 3% for a conventional loan, 3.5% for FHA. So I thought it might be helpful just to share with you some of the documentation usually needed for your home qualifying. So usually we're going to need to see the last 2 months of your asset statements. If you're going to use investment accounts like 401ks, 403bs, even IRAs, those can be acceptable. They usually have quarterly statements, so we want to see documentation for that. Usually with 401ks and 403bs, you're going to borrow money to use those funds. We really try to avoid that if possible, because we don't want you to have to take money out of your accounts or out of the market, which could impact the balances of those accounts. IRAs could have tax implications, so we always encourage you to talk to your financial advisor, maybe your tax advisor, about if that's going to be the right decision for you. And then gift funds can be potentially used for a home purchase. And what that means is if you have a family member that's going to help contribute to your down payment or closing costs, those funds can be used at any time. They don't have to be seasoned funds. And so what I mean by that is most assets require 60 days to be in your account and paper trailed. So like if I just put $5,000 in my account cash and didn't have a paper trail, that would not be allowable with financing. But if it sits there for 60 days and it's seasoned, then it's allowed. But gift funds, those can be transferred right away. We just gotta have to document what that looks like. Usually the donor has to complete a gift letter. They may have to show their bank statements of where their funds are being transferred, because everything in a home purchase transaction has to be paper trailed. So with loan products, you can not only have your savings, but maybe a donor can help with gift funds to contribute towards your home purchase. That is absolutely allowed. Okay. So Christina, I see your hand raised. If you want to just put your question in the chat or Q&A, I'll make sure we take a look at that for you. Okay. We're going to start moving now into our first-time home buyer program. So many of you have maybe connected with us through first-time buyer programs or seen some of the work that we do in our communities. Because as I mentioned earlier, there's kind of two things that maybe make it a challenge for first-time buyers. Could be credit, but what I see more often is just lack of savings for your home purchase. Maybe your landlord just said, hey, we're getting ready to sell our house now, and you would love to purchase it, but you're just not in a position to do that because you haven't really expected to have that savings available to purchase a home. And so we partner with CalHFA, which is the California Housing Finance Agency. We're very proud to be the #1 provider of these products across the state. And what CalHFA's mission is to create affordable and sustainable home ownership in our communities. And so what we're going to kind of teach on now is some of the assistance programs that are available to you as first-time buyers looking to purchase in the state of California. And so we're going to talk about some products that are available today to you. We're also going to just touch on some future programs that are available. And I think what you'll find is these are some great resources that are available to you that you may or may not have heard of. So the first thing is My Home Assistance. And what My Home Assistance does is it provides up to 3% of a conventional loan down payment. So if you remember from our class earlier, the minimum down payment is 3% for a conventional loan. The My Home would cover that full down payment for you for your home purchase. Now, if I'm looking at an FHA loan, the My Home Assistance would cover the full down payment for an FHA loan. So depending on what path we go down with our home ownership plan, the My Home Assistance would contribute that entire down payment. What's great about this program, if I've saved a little bit more and I want to add to my down payment, the My Home Assistance can complement whatever we have saved. My Home is a low interest loan at 1%. So just that assistance. So if I'm buying a $400,000 house, the $12,000 I get from the state is a low interest loan on the $12,000 at 1%. And it's simple interest. And what's great about it doesn't require payments to be made back until you either sell the home or if you refinance in the future. Now, that will help satisfy the down payment amount. Now, there also is closing cost assistance, which is called the ZIP assistance program. That can contribute anywhere between 2 to 3% of your loan amount towards your closing costs. That is an interest-free deferred loan, also not payable until you sell or refinance the home. The way the product works for the state assistance programs, we would have to first take advantage of the My Home Assistance. Once we would go ahead and utilize those funds, then if we still need additional funds, then we can bolt on the ZIP assistance program. And just had a question came in on this, so I want to make sure I comment on this. So there is no payments required until you sell or refinance. If you never sell, the assistance is not due and payable back for 30 years. So which would hopefully sync up to the timeline on your 30-year fixed mortgage. Okay. So let me show you an example of a conventional loan on how this assistance could help support you. So let's say I'm buying a house for $450,000. We know the minimum down payment is 3%, so that's $13,500. The closing costs can range anywhere between 2 to 3%, so that adds up to about $9,000 to maybe $13,500. So my expected cash to close is anywhere between $22,500 to $27,000. So most of our first-time buyers, if we were to share with them that number, that's probably going to be a bit of a reach for most of our clients. So when we add on the assistance program, here's what now it looks like. So I can add on the My Home Assistance program, that $13,500, that can help offset my minimum down payment. Now, if I was comfortable with that, then my expected out-of-pocket is probably going to be somewhere between $9,000 to $13,000. Now, if that's a struggle for me, then I could potentially add the ZIP assistance. But I will say the ZIP assistance does change your interest rate offering. It actually will elevate it pretty significantly. So we want to be cautious on adding that in, but it does provide anywhere between 2 to 3% of your loan amount in assistance. The average interest rate for most of these programs is right around 5.8 to 6% for the first mortgage. The rates for these programs are all set by the state of California through CalHFA. They do change daily based upon the market conditions. So the rate offering today for the moderate income first-time buyer was 6%. For low-income housing buyers, it was 5.875%. These programs do have income limits, and I'm going to share with you what that looks like in a second. But before I do, I want to kind of share with you, and we get a lot of calls for this program. It's a future program that's going to be launching, we're hoping April of this year. And it's called the California Dream for All program. And I was fortunate enough to be a part of the project team to help kind of collaborate on this. And what this program does, and many of you have probably heard about it in some of the media outlets. I know it was shared, I think, in the Sacramento Bee, if I'm not mistaken. And if you're down south, some of the Southern California publications. The California Dream for All program provides up to 20% of your purchase price or appraised value in assistance. It's planned to be a zero interest loan that also does not require to be repaid until you sell or if you refinance in the future. It's compatible with a conventional loan. So as we learned earlier with the PMI situation, if I put 20% down, I have no PMI, right? Now, this program works a lot different than some of the other assistance programs that are available this minute. And the biggest part is it has an equity share agreement. And what that equity share agreement states is that if my home goes up, let's say let's say my home goes up $100,000 in value over my time of ownership, the state would partake in 20% of that equity, or $20,000 over that time of ownership. So when I sold my home, let's say it's 7 years from now, I would pay back my 20% equity share plus the 20% assistance I received from the state. Okay, so this is a really kind of innovative product that the state has introduced because, they understand the cost of living is significant in our communities. And so the 20% just allows buyers to afford so much more in home ownership. Now, I do understand there's a trade-off of sharing in your equity. And for some of our clients, that might not be a draw. And they prefer to go with other programs. But I think it is a game changer for our communities. On average, what we've seen for some of the clients that we've done some what-if scenarios, it can lower your payment as much as $500 to $700 a month in your monthly home budget, which not only increases your purchasing power, but if you don't want to increase your purchasing power, it creates a lot more savings to make it more sustainable and affordable for you. We're going to have more details on this program as they get released. I know you're attending our first-time homebuyer class tonight, but we're going to be doing info sessions on the California Dream as it comes out. And we're encouraging, our folks in our community just to get connected with us to learn a little bit more about that product. Here's the income limits for the program, and they're by county. And these income limits are not just for the California Dream product, but they're for all CalHFA products. There is also a low income product option, which lowers the interest rate on a first mortgage by 0.125%. And the low income limit is 80% of the median income for the community. So right now in Sacramento County, it's right around $73,000 to be considered low income housing. Here's a few of the other kind of eligibility requirements with CalHFA. It's a minimum credit score of 640 for an FHA loan, 680 for a conventional loan. We talked a little bit about debt to income ratio. So those are the requirements there. This program is based upon applicant income, not household income. So most local community programs look at with the total encompassing household income. This just looks at the applicant income. So why that's important is that if, let's say, I make $150,000 a year and my spouse makes $100,000, our combined income is $250,000, which would push us over the limit. But in this scenario, if I just applied, for example, then only my income would be considered towards the income limits. Now, first-time buyer, as I mentioned earlier, and as we launched into tonight's content, is someone that hasn't owned in the last 3 years. So, if you have a house that you sold back in 2015 and now you've been renting for the last 7 or 8 years, you would now be considered a first-time buyer. Whoops. And this is eligible for single-family homes. You can buy new construction homes. Those are new construction production homes, like through Lennar, Beazer, some of the home builders here locally. Condos, townhouses are eligible. Even below market homes, we call those BMR homes, which are catered towards low-income housing families. Manufactured homes are eligible. However, they do have to be located on land that you own. They cannot be in like parks, for example. Okay, so that is the CalHFA first-time homebuyer assistance program. So I know I'll probably get a lot of questions on that. What we're going to do so we can get through all tonight's content, I'm going to kind of table some of the rest of the questions to the Q&A, because we're almost at the end here. I want to make sure I get you guys all this information. And we're going to move into the 6 steps of home buying. This is called the 6 steps, which is basically the milestones of the buying process for you. So we're going to first launch into step 1, which is the pre-approval step. And that pre-approval is kind of really a certification to sellers that I'm eligible for financing. That is like the output of a consultation we do with you. So one of the things we're going to talk about in just a minute is our one-on-one. It's basically putting a home buying plan together. And as we put that plan together, we're going to issue a pre-approval that allows you to go out and start doing your home shopping whenever that is. The pre-approval is usually good for 60 days, but we can always recertify your pre-approval at any time. Doesn't require to reapply or anything like that. And again, when we do your pre-approval, it is only a soft credit check at this point. Now, if you do want us to go and do a deeper dive into your credit and maybe do some modeling of your credit to see how we can help improve your credit, then we may recommend a full inquiry. But initially at the pre-approval phase, it's just a soft inquiry. Step 2 is going to be house hunting. That's where you get a chance to go do the fun stuff. You get a chance to look at different homes that fit your, the characteristics and location that you're looking for. We really encourage you to work with a realtor that hopefully is an expert in the market. As I mentioned earlier, realtors are paid for by the seller. So I encourage you to leverage that resource and support. We do have preferred realtors we work with across our communities that we serve. So if you want us to introduce you to one of those team members, we're more than happy to do that. And pre-approval letters can be adjusted based upon your offer price for a home. So depending on, where you're looking and what price level, we can always adjust your pre-approval to match that offer price. Usually in a consultation, we'll talk about your we're going to talk about your budget, but we're going to say, okay, what's the max? What's the ceiling that I want to have that pre-approval at? And then we can always work backwards based upon, what's affordable for you. Step 3 is going to be entering escrow, and that means I have an accepted offer with a seller. Okay. And as soon as we get word that your offer is accepted, we're going to reach out to you and congratulate you because it's a big, huge step in this path towards homeownership. And what we're going to do at that time, we're going to schedule you for a follow-up consultation. And that's where we're going to get together with you, design your financing options, show you what your interest rate looks like, your assistance programs, if you elect those, out-of-pocket expense, and just make sure you feel comfortable with where you're at in the process. Now, as a buyer, you're responsible to deliver an earnest money deposit at that time. Usually that has to be delivered within 2 to 3 days of the acceptance of offer. And an earnest money deposit is a good faith deposit. It's usually 1 to 2% of your purchase price. That is kind of that good faith deposit that the seller can see that you have a financial stake in this purchase. Now that deposit is protected by a thing called the contingency period. I'm going to share with you what that is in just a bit. But as we launch into step 3, we're also going to order an appraisal of your house, because we really want to make sure and to protect you as a buyer that your house is worth what you're paying for it. Here's a slide that kind of talks a little bit about earnest money deposits. So as I mentioned, it's 1 to 2% of your purchase price. Now, that deposit money is held in the escrow account and it's protected by your contingency period. The contingency allows you as a buyer to do your homework on the property. So you want to get the house appraised, which we'll handle as a lender. Your realtor will help support you with getting inspections done of the house. And then we'll get your loan approved. And I'll kind of show you where that goes in the 6 steps of home buying. But the timeline for the contingency is usually in the first 14 to 17 days of your contract, because we want to make sure that you've done that homework and you still feel really good about this home purchase. Step 4 is going to be processing and underwriting. That's where we do all the administrative work of your loan. Your loan will be locked in. Your interest rate is locked in for that time. An interest rate lock covers the whole duration of your escrow time period. Usually from step 3 to step 6, which is your escrow time period, is anywhere between 21 to 30 days. On the long side, it could be as long as 45 to 60 days. I would say on average right now, we're seeing escrows around the 25 to 30 day mark. Step 5 is going to be loan approval. That's where our underwriters have issued a full loan approval for you. And that takes us to about 3/4 of the way through the escrow time period. Now, at that time, we're also going to be probably right up against the contingency time period. So if you've done your homework with the inspections, the appraisal checks out, we have your loan approval. If you still feel comfortable moving forward in the process, then you're going to release your contingencies. That tells the seller that you've done all your investigative work and you feel really good about moving to the final stages. We're also going to issue to you a final closing disclosure. Gives you a 3-day cooling off period before you get to the very final stage, which is closing your loan. That's a big day, because at that point, you're going to be signing loan documents with a public notary. That generally takes anywhere between an hour to an hour and a half. At that time, you'll also wire in your final funds that you owe in your transaction. As your lender, we're going to wire the funds that you're receiving from your loan, as well as any assistance programs. And after those monies get all reconciled and balanced out, the escrow team will release documents to the county recorder's office. They're usually going to send a grant deed, which transfers ownership to you. They're also going to record a deed of trust. And once those items are recorded, then you'll become the official owner of the house. And that's a big day. We're going to be right there side by side with you guys as you go through the process, because we're going to celebrate and give you a virtual high five, because it's a big accomplishment getting to the finish line. And our team is there to help support you through the process. So whether you're at step 1 or step 6, we want to make sure that we're connected with you and answering all your questions for you. Okay. Now, just as a side note, you receive disclosures throughout the home buying process. Everything is done electronically except for step 6. That is done in person with a public notary. Okay, so you heard me mention a little bit about consultations. That is kind of the first step as we get ready for the 6 steps of home buying, and the output, of course, will be the pre-approval. Now, after today's workshop, if you have a few questions for me and you just want to kind of maybe just run some different scenarios by me, maybe it's a credit question, down payment, student loan question, we would love to connect with you for an introductory call. That's like a 10 to 15 minute session. You can use the links here on this slide to be able to book that. Or if you want to talk about what the process looks like. Now, if you're ready to get started and you want to kind of understand what a home buying plan looks like for you, we really encourage you to do a consultation. That consultation includes completing an online application, uploading documents, and then we meet with you for that video session. That's usually 20 to 30 minutes. All those different sessions are one-on-ones with me, and those can be booked using these links here. Okay. And we have a full scheduling system, so it'll basically be based upon whatever's good for you and your schedule. You can select the best available times. Here's kind of the framework of a consultation. You've heard me talk about it a few times tonight. Budgeting, we're going to talk about the process, interest rate options, product options. We're going to maybe even look a little bit at debt to income ratio and some of your existing obligations. And the output of that session will be to hopefully have you pre-approved and have you on that path towards home ownership. Now, whether you're going to buy in the next month, next couple months, or maybe even next year, at least you can have some goals and objectives to help you hopefully obtain home ownership. Okay. Here's the link to our APM mobile app. So take a look at that. It's available for Apple and Android. Really cool calculators available there. In fact, you can even start your app right through our mobile device. And as I started tonight's session, many of you have heard about our workshop or attending our workshop because of our Sac State partnership, which we love with both athletics and alumni. We're also affiliated with other universities, not just in California, but across the country. We provide a $750 discount in closing costs through those partnerships, and of course provide consultations at no charge to help kind of guide our clients down that path towards home ownership and help build that home buying plan. Now, as I wrap up tonight, we're going to kind of finish off with a couple of questions, but I do want to pass along all my contact information to you. So if you do have some questions after tonight's session, want to message me, give me a call, you send me an email. And we've been teaching classes for the last 7 years, believe it or not. And, we've taught over 2,000 future first-time buyers last year, and many of which have become first-time home buyers now, owners. And so we love what they share in their testimonials on both our Google and Yelp reviews. And so, we would encourage you to check out what our communities are saying about us. And we really try to make sure we keep all of our clients up to date on what's going on in the market, whether it's new product releases, what's going on with interest rates. So we encourage you to follow us on our Instagram. We really try to put out valuable content out to our local communities. Okay. So I really appreciate everybody joining us tonight. Now I'm going to open it up for Q&A, and then and we'll kind of answer all your questions tonight. Make sure that you got all the information you expected out of tonight's session. So, question came in, which was around closing costs. And so the question is, why would closing costs be a percentage going up as the home goes up? Why would it cost so much more to a $300,000 home versus a $100,000 home? So that's a great question. So $100,000 home and a $300,000 home, those closing costs probably will look a little bit different. Just as a general rule of thumb, we say 2 to 3%. However, there is some fixed expenses with closing costs that will not change based upon sales price. So those are things that we can dive into a little bit more granularly with a consultation. Okay. And then somebody asked me to show the previous slide. So there you go. Previous slide is up. All right. And then Ken put in the chat just the links for any type of scheduling that you guys would like to do for either intro calls or for a full consultation. So that should be in the chat. You can tap on that link if you want to. Another question came in. Are there any grants available for first-time home buyers in California that we don't have to pay back? Right now, the state does not have any grant programs. There was a program available in 2022 for low-income buyers. In fact, for grant programs, you're going to have to make less than 80% of the median income. Other programs, the state program is a bit unique because it's 150% of the median income. There is a program available in Long Beach. I know that just launched or it's getting ready to launch. That I think it offers up to $20,000 in non-payback assistance, but right now it's very limited on what's available for grant funds. So a question around the California Dream product. When do you pay back the 20%? So the 20% is paid back when you either sell the home or if you refinance. And then what it would look like, basically, if I sold the home, then my proceeds that I receive from hopefully my home being worth more when I sold it, some of that would go towards the 20% that I originally borrowed for the down payment, and then the remaining would go towards the equity, the shared equity. Now, potentially there is going to be a one-time option to refinance your loan because rates are still at higher levels. The state may have a component that allows you to refinance as a one-time and not have to pay back the assistance at that refinance event, as long as you improve your interest rate by 1%. The guidelines have not been published yet, so that's not public knowledge yet. But hopefully, once we get that, we can definitely share that with our guests. So question is, does married versus unmarried partners make a difference on qualifying? Absolutely not. So it does not change anything. With combining yourself with your partner in your application, we look at the credit obligations as well as the dual income. So whatever that looks like, we blend both of those together. And then question is, what is considered the median income? So it depends on the county. So right now, median income here in the county is just right around 90,000. I'll can put it up for you guys, but it's basically, let's see, 80%. So 80, we look at the 80% number because we look at 80% of the median income, which is 73,000. That's what the homebuyer programs are based on. And then do you anticipate the buyer housing market to get more favorable in 2024? That's a great question. I think, the markets right now is probably more favorable for the buyers. I think depending on the path we go as an economy, if we go into a recession, generally a recession will lead more potential buyers moving money out of equity markets into real estate, which will create more competitive environment. So we'll have to see what that looks like. I think it would be important just to keep on checking in with us on what we're seeing out there. What I've seen right now, at least, is certainly a buyer's market. Question is, if we ask the seller to cover closing costs and we are a state worker, do we still get the $750 cash from the deal, or the extra discount is moot? So what we do in our discount program we provide, it reduces our normal fee of $910 down to $160. So you'll get that if you're part of our partnership. A seller credit can be used to help offset other costs that are involved in the transaction. And then what is the best way to get credit utilization down? So really it's going to come down to really paying down those balances to help increase the increase the more available credit, or basically lower the balances. If you had a higher credit limit too, then you'll have a bigger spread between the balance and the credit limit, so that could lower credit utilization. But it's really going to be about paying down those credit balances. I have a lot of clients right now that hopefully are getting tax refunds, and as we're building home buying plans for them, some of them are going to utilize those refunds to pay down some of their credit card debt. And then a question around multi-unit properties. So for a multiplex as a first-time home buyer, how do I know if 50% versus 70% of the rental income can count towards my income to qualify for this loan? I heard it depends on the mortgage company. So for first-time buyers, they're going to buy multi-unit properties. The assistance program would not be compatible with that. You have to buy just one-unit properties to be able to use assistance. But if that's a non-issue for you and you're not looking at using assistance programs, as a first-time home buyer, usually they'll take 75% of the gross rents, and that will be used as a potential offset. But it depends on the product that we're going to utilize. Is there a simple equation we can use to see how much more house we can buy instead of buying a condo townhouse with, say, a $400 HOA? Not necessarily a simple formula, but during a consultation, we side-by-side comparison single family homes with no HOA versus condo townhouses with HOAs. So I'd encourage you to just connect with us for one of those. We can run some formulas for you. That's a pretty easy process. Condos, townhouses versus single family properties can tend to have lesser homeowners insurance too that's required. So that could change things a little bit as well. And then the question was, some lenders offer 1% deduction for the 12 months. Is that something you'd also offer? I'm not quite sure. You might have to elaborate more on that question. I think what you're describing is a buy down option. Some lenders will do 2-1 buy down options where you can buy down the interest rate for 1%, but it's not coming at no cost to the consumer. So buy downs were pretty popular about 2 months ago when interest rates were in the 7% range. And what had to happen in that case was a seller would have to contribute to the buy down of your interest rate. But yeah, any reduction of interest rate will not come at a cost to the consumer. And then the question was, which is easy, I can answer that one, show my contact information. So there's my contact information. So again, please feel free to reach out. Can also put in the chat the income limits for CalHFA so you can see those. And then again, those are going to be the moderate income limits that are available. Okay. Just a great question content tonight, guys. You guys, I really appreciate all the questions you're giving us. Anything else that we can help answer for you tonight? I know we're a little over time now that we answer questions. We got it. Okay. So a question was, what would you suggest for someone who wants the lowest mortgage possible? So I think everybody wants the lowest mortgage possible. I don't think that's just, I think everybody would like, I think the question would be is designing a financing option that can provide the lowest mortgage option is going to be a product of, you know, where you're at from a credit perspective, where you can get to from an interest rate perspective, and really what you're going to finance. So, you know, I think with anything, it's not just about price, it's about looking at the overall kind of the overall game plan. So I would encourage you in that scenario, just talk with us and see, we can see what that looks like for you. Okay. All right. All right, very good. Well, I'm going to go ahead and sign us off now. I really appreciate everybody joining tonight. No, it's not easy getting away on a Wednesday night to hang out, learn a little bit about finances, but hopefully this was time well served for you. If you have any questions, please feel free to reach out to me. And I really hope we get a chance to connect with all of you in the future. Have a wonderful evening, and here's to a great 2023.